Jonathan Rose here, active day trader. I got a really special trade today, a trade that I really like. So one of the biggest lessons that I teach my members is every single trade that you make, you need a catalyst, you need a reason. We don't want to just use technical analysis, follow lines and buy, sell, buy, sell, buy, sell. That doesn't work. We want to have ideas backed by a good thesis, a good reason. October 17th. Marijuana is legal in Canada. That's going to be next week. There's most likely going to be a pop, an increase in volatility in that day. I personally think marijuana names across the board are all going to rally going into legalization. That's just how these things work. Canopy Growth, one of the bigger companies, one of the more stable companies. Right now, it's trading at $49.49. Okay, I put up the straddle so we can see the market's expectations going into November. CGC, November, there's 35 days to go until expiration. Last trade, 49.47. So if we look at the 50 strike, we would look at the straddle. On Thinkorswim, I could just go here, straddle, and you can see the straddle is about 10.20, 10.30 mid-market. $10 is about 20% of the overall price. Okay, it's saying it's $11, so maybe 22%. If I take you back to the chart, 22% is what's shown with these lines. So if we buy the straddle, CGC moves away from these lines, we're going to make a whole bunch of money. If you buy the straddle and CGC doesn't move at all, you're not going to make a whole bunch of money. You're going to lose money. The reason I think that CGC can really move is, for one, Canada goes legal next week, October 17th, so there's a major catalyst. The second reason is going to be because of earnings. Canopy Growth has released earnings 3 times so far since it's been listed in the US. There's obviously so much uncertainty around these companies. Plus the legalization next week. Those 2 catalysts alone are going to make this thing really move. CGC has only released earnings 3 times. The first time they released earnings was back in November 2017. The stock ended up rallying like 40%. In February of 2018, they released earnings again. Stock was down 24%, ended up rallying. And then in August, stock rallied, I think 20% right after earnings, but ended up rallying like crazy, as you can see right here. There's just not enough data for Wall Street to properly value this name. So having a straddle that's 20%, considering it's moved over 20% on every earnings release so far, also there's the legalization next week. In my opinion, and I was a market maker for 5 years on the floor of the Chicago Board Option Exchange, they're just wrong. I think that they should be pricing in more volatility, more uncertainty. Because who knows where the heck this thing's valued at? It's all speculative. So as options traders, we can just take advantage of that movement. Now, it's a little expensive, but that's okay. It's trading at 87% volatility. The straddle's pricing in about a 22% move. You could just buy the straddle, fine. I'd rather go out a little bit, maybe do the 60s for $2.10, and then $10 lower, you can do the 40s for $1.35, something like that. Wow, this downside. $1.35. Holy SKEW. So look at that, guys. Look at the SKEW. How cheap the downside is relative to the upside. So you can do the 40s. Maybe you want to go a little bit higher to the 65s because they're cheaper. But overall, the market is pricing this thing to go higher. It just is. You might want to even do a 2-by-1, 2 upside calls to 1 puts. Or what's also kind of a fun thing to do is you can buy the 60s for like $2.10. Who knows what price it'll be when you're looking at. But you buy the upside calls. Next week, we play for a bounce. We play for CGC going higher. As it goes higher, then you slowly get into your puts. Don't get rid of your calls. Enjoy being at a profit on calls as they rally, but then slowly get into the puts for a cheaper price. That's really the way to play it. Canopy Growth, CGC, I love this idea. It's not too often where you see a skew to the upside like CGC. And again, the skew, the upside options are priced way more expensive relative to the downside. The market's expecting CGC to go higher. Let's ride the coattails of the skew. Let's get long the upside calls. As it rallies, we'll buy those puts. Just give me a promise out there. If you get into this trade, we're in it until 35 days. There's no freaking stop when you trade options. There is no stop when you trade options. There's no stop because if you buy 10 of these for $1,500 and you want to get out, you get out for $1,300. You're losing $200 just on execution cost alone. Don't stop yourself in options. The strongest thing you have is your optionality. Hope you enjoyed this. I share trades like this every single Sunday night. I share 8 to 12 trades with my members. Every single one of them have a why. You want to check it out? ActiveDayTrader.com/you free. See you on the inside, guys.